we do think there's a bounce coming today, maybe day one of the bounce, and it may be only 3 or 4 days, but it may very much be that we get back up to near 6,000 on the S&P 500.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of another week. It's a good week because instead of Lance Roberts, this week we have the unflappable portfolio manager, Michael Lebowitz. How are you, Michael?
I'm doing great. Thank you.
Yeah. All right. Well, look, I used unflappable for two reasons. One, because you are a very even-keeled guy. You bring a lot of calmness even when the markets are as volatile as they've been the past couple of weeks. I thought it was a good week for an unflappable host here because I think a lot of folks are feeling the sting of the past couple of days in the markets. So
Right.
if we can, let's pull up the S&P chart here then, and let's actually, as we're flying through this uncertain time where we don't have a lot of range of vision, what are instruments telling us right now?
Okay. So we have a few things going on here. This is the S&P 500. It's broken all critical support, the 20 to 50 and the 200. And you can see it's really the first time it's broke the 200 since going back to Halloween of 2023. Now, what's important here is it did break it. And, while these moving averages and other trend lines are very important, they're not perfect. And quite often it will go through, the price will go through a trend line or through a moving average and then revert back above it or below it, whichever the case may be. So here you can see we've dropped below it for the last 5 or 6 days. That's concerning. But now what we want to see is on the bullish side, we want to see it get back above the 200, maybe retest the 200, go back down to it, and then pop higher. What we don't want to see is it go up to the 200-day moving average and bounce off it and go lower. So that's one thing we're closely watching. And then you can see the 20 and 50-day moving averages up here are another point of resistance. So those are the first kind of two hurdles that the market has to make. First one being the 200, get above it. Second one, the 20 and the 50-day moving average. And then the last hurdle will be the prior high. We think it's likely one of those three that will be the end of this bounce, and we could resume lower. So further evidence, though, that we are in for a bounce is the MACD, moving average convergence divergence. And two things to note here. One is just how low it's gotten. That's much lower than prior lows. You can see it this low in 24, this low in 24, 23. It's gone well below that. But it's starting to look like it's getting ready to turn up. And I have another graph for you a little bit later that may be a leading indicator of this to help us. But when the blue line can get back above the signal, which is the red line, that denotes that it's a bullish flip in the MACD. We're not there yet. The RSI on the very bottom is turning up. It usually turns up first. It's usually an initial indicator. But, like you can see back October 23, it turned up, went back down. It's not necessarily, it doesn't trend as well as the MACD. So it could just bounce along the bottom as well. It's just very oversold. And Lance's new favorite, the money flows. And you could see they're negative for the first time in a little while since the beginning of the year, but they're not deeply negative. So it tells you there has been decent support despite the sell-off. So you can read this two ways as well. Either that support's going away and that money flow indicator is going to get much worse as all those people buying are just getting tired of getting run over and will sell, or that the market's still in a bullish trend and will continue higher.
Okay,
So
go ahead.
no, so we do think there's a bounce coming today, maybe day one of the bounce, and it may be only 3 or 4 days, but it may very much be that we get back up to near 6,000 on the S&P 500, or that we challenge the 20-day moving average, which is just a hair under 6,000 or around 6,000. Um, so that's, kind of what we're looking at now. We've done some trades to rebalance back into some of those higher growth tech, high beta names, anticipating a rally. Again, we don't know if this bounce is a 4 or 5 day bounce or a 2 month bounce or even longer or a resumption of the bullish trend. And again, while we may have our opinions and our gut is telling us something, the technicals are, these and many others that we look at are guiding us and kind of telling us how to trade the market.
Okay, so right now the technicals are telling you, hey, it looks like we'll say the rubber band has gotten stretched probably to its maximum here. You're seeing some initial indications on both the MACD and the RSI that it may be starting to slightly snap back here. So my guess is you would say that your base case here for the next couple of days, weeks, is back to your and Lance's original thesis for the year, which is it's going to kind of be, a volatile roller coaster where it's going to be, ups and downs, ups and downs. We may be completing it down right now. We'll go back up, probably,
Mhm.
punch through the 200-day moving average. And Lance has been saying, so I want to see if you would corroborate this, that we are probably in an environment that's a sell the rip environment, which is,
Mhm.
once you go through these downturns and you get that bounce, rather than adding back in and trying to see how high the bounce goes, it's more, hey, if this thing gets high enough, let's start lightening up on some of our positions that we were feeling a little nervous about when the drop was happening.
I think that's fair. Um, Obviously, when we get up there, when we start climbing that next hill, we'll see what the technicals look like. We'll see what's going on politically, geopolitically. And the other thing I didn't mention, which is very important, is that sentiment. Things like the fear greed indicator and so many the AAII surveys, they are so washed out. Sentiment is so bearish that it's at levels you typically see at significant market bottoms. And that's, that's unusual to see it after 5-10% drop. So that again argues for the rubber band theory that's just stretched too far. Doesn't mean it can't stretch a lot further over time, but for the moment we've stretched it too far and it's got to come back a little.
Yeah, and let me share this chart too that Lance actually shared on his X account the other day. It is a chart of retail purchases of U.S. stocks and ETF by day, and basically showing that as the market has been declining here, that people have actually been buying more. And so this isn't a sign, even despite the sentiment that you talked about, it's not a sign that people are capitulating and giving up, and are frightened and getting out of the market. It's that they're coming in saying, "Is this the bottom? Is this the bottom? Is this the bottom?" There's still speculation here of like, I still want to play this thing like a casino. So in Lance's, words here, he says, "Look, we're not going to get into a bigger corrective cycle when retail investors have FOMO over missing the dip." So again, we'll see what happens, but if people were selling into this, that might be a sign that, hey, this thing has further to go because people are getting out of the market, where it does seem that there's still some optimism, there's still some speculative hunger here.
But tops are a process. Forget 2020. That was a black swan, something no one could predict. It just happened almost immediately. The economy just shut down. The global economy shut down. We've never seen anything like that. Tops typically, that's not how tops work. They're processes. It looks kind of like a mountain range where you're setting higher highs and higher highs and the economy, everything's going well. And then all of a sudden you drop and you set a high, you bounce and you set a high, but it's not as high as the last one. Now you're setting lower lows and lower highs. And there's a rounding process to that, which helps you understand what's going on. That's why what happens next? If we go back to new highs, we're still back in that bullish trend.
Right.
going back from the recovery in 2020. If we go back and we set a lower high, and then a lower low below where we were yesterday, assuming today's the bounce, who knows? But that's a sign that, we have to start being a lot more careful that we may be in a downward trend and our roller coaster may end below where we start. Um, so if you want, I created a little PowerPoint this morning with just a few of the things that we're looking at to
Perfect.
help better assess the market. If you want me to share that?
Yeah, no, absolutely great segue. And whether it's while you're going through it or after you're going through it, just one big question is are you guys at RIA, are you adding here? Like, hey, we think this is more likely than not a tradable bounce, and therefore, we're trying to add back in at some lower valuations here, or are you just sitting on the sidelines waiting and seeing?
So over the last 2, 3 weeks, we've rebalanced. So what that means is, let's just say you know, Apple's a 5% position in our portfolio, and we have 25 or so stocks and bonds, and everything's moving. If Apple's underperforming, all of a sudden it could be only 4.5% of the portfolio. And something that's doing well, Johnson and Johnson, that was also five, could be 5.5. So when we rebalance, what we're doing is buying Apple back up to that 5% model weight and potentially selling Johnson and Johnson down to the 5% model weight. So we're taking profits on J&J and we're adding a little bit to Apple. We've been doing that. We took profits on some of the drug companies we own, uh, JP Morgan, Walmart, a few of the safe, more conservative companies. And then over the last week, we've been buying the beaten down stocks, Google, Microsoft, Nvidia. We actually added 1% to ANET. I'm sure I'm missing a couple, but we basically a few weeks ago, a month ago, we took profits in some of the more conservative names that were just getting too far ahead of themselves. And then over the last week or two, we've been adding to the names that have been beaten up. Not our exposure hasn't really changed all that much, but we're rotating with the market.
Okay. And
So
this is sort of what Lance talks about, when he talks about his principles of gardening in the portfolio. And really what you're ensuring you're doing here is you're selling high and buying low here.
trying. That's the
Yeah.
name of the game.
Yeah.
So, and actually, the graphs and charts I'm going to show you kind of give you a little bit of insider baseball here, kind of some of the tools that we use to do this. So I put together about 4 or 5 charts that are kind of some of the things we've been watching to help guide us to basically calm our nerves down, to help us appreciate what's going on in the market. And the first one is probably one of the most simple tables. Just also keep in mind, all of this is from SimpleVisor except one chart. And when we get to that chart, I'll tell you which one it is, but everything else is from our SimpleVisor website. So this market summary is on the home page, and it's a very simple way to see what's going on in a market at a very high level. You could see at the top, you could see what's going on for the day, the week, the month, quarter, out 2 years. And all we do is separate out large, mid, and small cap, so size of stocks versus whether they're value, kind of in between value and growth, or just growth. And the one thing that has stood out like a sore thumb is the circle I made. It's the large cap value stocks. These are year-to-date returns. Large cap value is only down 2%. Large cap growth is down almost 8%. And you can see as you get to the smaller cap growth, even mid cap growth, down 9, 10%. So large cap value has outperformed everything by a long stretch. We've seen that, the names like JP Morgan, Exxon, those Berkshires, those more value oriented, non-tech, not high beta stocks are just have helped us have they buffeted our portfolio significantly. There were some of those big down days where half our portfolios were up. And in large part, it was those large cap value stocks. So with that, we have a rotation tool in SimpleVisor that we look at every day. And it works on both sectors, the 11 S&P 500 sectors and factors. So factors such as value, growth, large cap, small cap, and I think we have 21 or 25 factors that we can kind of categorize stocks into. And what I have here is, and what we do with these is we create scores, technical scores. We apply 14 different technical indicators and analyses to them. And from that, we get a score, one being the highest, -1 being the lowest. And they range between that. And when it's close to one, it's very overbought. Close to -1, it's very oversold. And what we tend to find over time is that those stocks that are very overbought tend to underperform, and those very oversold tend to outperform. Now we do two calculations. One is just on the price itself. That's called absolute. So we apply these technical indicators to the price of, let's just say, consumer staples. And it spits out a number and it tells us just whether the stock is overbought or oversold. The other one we do, which is very important, is the relative analysis. So instead of using the price of staples, we use the price ratio of staples. So what's the price of the staples ETF divided by the S&P 500? And we use that price ratio. We apply all those technicals to the price ratio, and we get a relative score. So the market could be plummeting, but if staples are beating the market, it could be relatively overbought, while its absolute score could be very oversold. So, kind of keep that in the back of your head. Now, you can list them, sort them, you can look at the underlying stocks within the indices to see how they're doing. But we also have this graphing tool where you can graph all of them or some of them. So what I did was segregated out IVE, which is large cap value, and IVW, large cap growth. And what this does is it tracks the daily relative and absolute scores over the last, I picked 5 weeks. And those little red arrows at the end of the blue and the red lines show you where they're at today. And you follow the lines back to the beginning, you can see where they started. So let's just look at the blue line. You can see that the absolute score improved, kind of stayed the same, and it's deteriorated. So as the market's been selling off, its absolute score was kind of staying the same, meaning that large cap value was hanging in there despite the market selling off. But recently, they've been selling off too, and you've seen a deterioration in the absolute score. But the relative score over the period has improved until very recently. So it's been outperforming the market. Conversely, growth started in the upper right quadrant, meaning that it was overbought on both a relative and an absolute basis. Now it's oversold on both a relative and absolute basis. So it's a way that we can kind of chart and see what's really going on, because sometimes it's not as, the table I started with and other things don't really tell you the full story. This shows you how they've been basically rotating in opposite directions. Very helpful.
Yeah, and so a trader here might look at that and say, growth may have the beatings in growth may have played out here because it doesn't have too much more to fall, and its most recent data showed that it was actually rising on the relative score, whereas IVE value, you might say, hey, that's the good days have played out, and maybe now the market's getting ready to rotate back into growth.
So what is a rotation? Rotating is a circular move, right? So, and these do not rotate in perfect circles. But if the trends continue, you can see that the red line's going to come back up and around, and in clockwise fashion, and the blue line is in counterclockwise fashion, heading down and to the left, right?
Yeah.
Doesn't happen nearly as nicely as even this graph shows. There's nothing stopping IVE from going back up and to the right and IVW going down
Right.
or
It's just a
backtracking.
snapshot, but
It's a snapshot, but they do tend to rotate
Yeah.
in somewhat choppy fashion. Uh, the next the next one's going to really, I think, blow your mind. So what we've done here is, remember we talked about the relative analysis. We
Mhm.
take the price ratio. What's IVE, the price of IVE divided by SPY. And that gives you basically just the excess return. So what I've done here, and this is stock charts, this isn't from SimpleVisor, is graph the price ratio of IVE to the SPY, the S&P, and growth, IVW, to the S&P 500. And you can see that they're mirror images of each other, right? It's almost perfect. It's kind of
Hmm.
eerie. And what that's telling you is that on days when value outperforms the market, growth underperforms, and vice versa. It doesn't mean if let's just say the market's up 1% one day, all this means is that growth was up 1.25% and value was up 0.75%. They can both be going up, but that relative return to the market is almost opposite on, almost any given day. Um, and we have within SimpleVisor, we have a tool that helps us spot what factors are like that was almost a perfect correlation, a negative correlation, right?
Yep.
But what other factors are doing that? Where else can we say, okay, if small caps are overvalued, what's going to be undervalued? Where can we expect a rotation? So I clipped this screen. It's actually a much bigger table, but I clipped it because what this shows is over the last 126 trading days, it shows the correlation between all these different factors. And I've in the yellowish blocked off areas, again, we're comparing value to growth. The intersection of those two yellow rectangles is the correlation. So over the last 126 days, the correlation of those excess returns, which is very similar to the graph we just showed, is minus 0.97. It's almost perfectly negatively correlated. If the market's going to be up, growth will be up more, value will be up less than the market, and vice versa. So we can use this table to help us find other things. So, if you look to the right, you could see MGK has a very negative minus 0.92 to IVE, which is value. So that's large cap. Those are, the largest names, mega cap. And you could, there's other ones that are in there as well. Um, so the point in showing you all these is that it's clear that the market has been favoring large cap value, selling large cap growth. So if we can understand how that is, is large cap value still in vogue and large cap growth still being sold? And if we start seeing signs of life in large cap growth, that may precede the market as a whole. So the next tool we have is let's just chart the price ratio of IVE to IVW, right? We're continuing on the same theme. And the blue line, and so there's four charts here, right? The blue line is that price ratio. And what you can see is that generally over the last, I guess, year and change, it's been trending lower, bumpy, but trending lower. And since about mid-February, it bounced up. Now, keep in mind, the price ratio went from about 1.85 to over 2. So that's, a 7-8% change. That's the outperformance that we've seen that we showed in that very first table, that approximate 8% outperformance. So that's nice to see, but what we can then do with this line is apply technical analysis to it. And that's where we have these three charts here, and I've circled where they are currently. The first one is a proprietary oscillator that we use. It's very similar to the MACD, but it has different specifications. And again, like the MACD, we can see it's still in buy mode. So buy EVE, buy value, sell growth, but it's very high and getting ready to turn. The next one is the MACD, very high, getting ready to turn. And then the third one is a stochastic model, which has probably turned today. So they're all telling us the same story that the value growth trade is getting long in the tooth, and value and growth may be ready. Investors may be starting to rotate into growth at this point. And then I'm going to end with Nvidia. What's the growth story? It's Nvidia. That's been kind of when you talk about high beta growth, that's been Nvidia. That's the market darling,
Then
or
the
the
poster child.
market.
Yeah.
Yeah, I mean, stepchild recently, but it was the darling, the Cinderella. And let's just look at the graph of Nvidia, because I think Nvidia will lead the market. It led the market lower. It's probably going to lead it higher. And what we see here is that it looks like it's turned already. It's been much more resistant the last few days in the market. It's outperformed the market over the last few days. And on the top, we can see the MACD is, if it hasn't flipped, it flipped today onto a buy signal. And you can see the last three times it's flipped. Those green bars show you the last three times it's flipped from very low levels. You've had a decent run. The first run in what is that, May of 24 was huge, from 90 to call it 150-ish. That's a significant rise. The next two following the green bars were still nice, but not to the same degree. And it looks like we're about to trigger another green bar, so we could see more gains coming from Nvidia. On the bottom, you can see the RSI, unlike the S&P, which we showed, has shown a more definitive bounce. So, and the money flows, which is the greenish behind the price, haven't turned yet, but we suspect they will change too over the next couple days. But again, just like the S&P, you got some key moving averages dead ahead that we need to get through. The overlying point is that high beta growth is showing signs of life before the market is. And that's maybe a sign that this market is getting ready to turn around.
Okay. So, early indicators seem to suggest that, yeah, maybe the beatings are ending here, and the market will have, some sort of material bounce going forward from here. Not enough that it sounds like you're buying, hand over fist, like, oh my God, we're going to new highs. You're doing more of the.
Well, let's backtrack on that. We are more or less fully allocated. So no, we're not really doing backflips and buying more. But if I was an investor that liked, let's just say I'd like to have a portfolio that's 50-50 stocks, bonds, but I only had 20% stocks today, I would be buying here.
Okay. All
Maybe
right.
for a
Okay.
trade. It may be for a trade, but I would be
Yeah.
buying because I'm under allocated. We're not under alloc, we're slightly under allocated, but not meaningfully enough to matter. So there's no reason to press a trade like this.
Okay. Well, thanks. That's good clarification. But basically, you're kind of becoming short-term bullish on the market given these indicators. But it sounds like what would invalidate that would be, well, obviously continued weakness in the market, or if it went up to the 200-day moving average and then fell again. In other words, if what was once deep support now becomes resistance, that would probably tell you there's a different game now in play, correct?
Yeah, yeah. I mean, it's not just the 200. It could be the 50, the 100, or the 20. And then we go back and set a lower low. That's not good. Or you know what? The market does okay for a few days, and then large cap value starts killing it again, and growth is getting hurt. Those are all, and there are a lot of other things we're looking at too, but those are the kinds of things that we're paying attention to. If Nvidia starts crapping out, if some of those other high-tech names starts failing, crypto, that's another one, right? Crypto led this thing too. If crypto starts having trouble, even before stocks, that may be a sign. So, like like an airplane, there's a ton of gauges to look at, and it's not just one gauge. Like a car has one, you're right, this speedometer, right? There's
Yep.
pretty much it. Maybe RPM if you got a fancy car. But, an airplane has, I don't know how to fly an airplane, but I've looked up there and there's stuff all over the place. And, Lance and I are looking at tons of gauges, and sometimes they all jibe, sometimes they don't. And that's what we have to steer this plane with.
All right. Well, look, thanks for sharing that. Again, congratulations on performance to date this year. No guarantee about what your future performance this year will be, but as you said, we'll knock on wood and keep fingers crossed. All right. Well, look, Michael, it's great. Like I always say, that Lance guy should go on vacation a lot more often.
No, no, you don't want him on vacation because he was on vacation Monday through Thursday, and you saw what happened with the
Yeah,
markets.
I know. I know. That is the curse of being in this business, right?
You may like interviewing me more, but you want him at his desk because the markets are in much better shape with him there.
Okay. So his correlation with the market is basically -1 in terms of his presence in the office.
Yes, yes.
Yeah. Okay. Or I guess his absence from the office is -1 correlated with the market.
I'll
All
add
right.
that to our simple visor,
Great.
that
That would be
analysis.
excellent. I'm sure. Yeah, exactly. The most important correlation, Lance's travel schedule. All right, folks. Well, look, if you've enjoyed having Michael on, which I'm sure you have, please let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Thanks again for stepping in for Lance, Michael, but you're welcome here anytime. I know you're enjoying some of the March Madness basketball this weekend, so have a great time there.
Thank you. Thank you. Looking forward to it.
All right. And everybody else, thanks so much for watching.